Welcome to the Crypto Teacher. And guys, I come back with that video just to make you think. And guys, it's unbelievable to think about all the things that NWO is able to get away with on the sheet. Guys, Congress had a meeting on UFOs. Project Blue Beam is coming back, and remember the Crypto Teacher told you. The alien invasion and the metaverse. Unbelievable. But guys, we had Jerome Powell blame all this inflation on everything else but the Fed. But we know how they do. They cause the problem, wait for the reaction, and run in with the solution. And right now, they're causing all types of problems. It's order out of chaos. But Jerome admitted they're going to keep raising rates until they see inflation coming down. We know the only tool the Fed had was to raise the rates in order to control what they caused. And you guys know I was getting you ready for this late last year. And he said they're going to keep raising rates until the fourth quarter. And also the unemployment rate is above this 3%. And we know that is correct. We know all the people that fell out the system, they are not counted. If you're not getting unemployment benefits and you're not working, you're not counted. And the Fed printed all this money so they could send people $10,000 to sit at home, so they could start the planning and building of the fourth industrial revolution, where the robots, algorithms, and drones take over the economy and the sheep go inside the metaverse. And remember, the Crypto Teacher told you, because he knows. When it comes to the New World Order, it's all planned out. You have a wonderful day.
Monetary policy works through expectations. So markets are pricing in a series of rate hikes, a significant series of future rate hikes, amounting to already having done that. So we like to work through expectations, and I'm not blessing any particular day's readings, but it's been good to see financial markets reacting in advance based on the way we're speaking about the economy. And the consequence, as I mentioned, is that financial conditions overall have tightened significantly. I think that, if you broadly across financial conditions, you're seeing that, and that's what we need. What we need is to see really growth moving down from the very high levels that we saw last year, moving down to a level that's still positive, but that will give the supply side a chance to catch up, and a chance for inflation to come down as we get supply and demand back together. Because we're moving about as fast as we've moved in several decades. But I guess the way I would say it is this: what we need to see is clear and convincing evidence that inflation pressures are abating and inflation is coming down. And if we don't see that, then we'll have to consider moving more aggressively. If we do see that, then we can consider moving to a slower pace. And it's going to be a judgment call that we make going forward as we carefully monitor incoming data, the evolving outlook. How are financial conditions changing? How are they affecting the economy? And that's how I think about it. We're raising rates expeditiously to what we've been saying, to a more normal level, which is something that we'll reach maybe in the fourth quarter. But it's not a stopping point. It's not a looking around point. We don't know with any confidence where neutral is. We don't know where tight is. We just don't, and particularly in this environment of higher inflation and very strong growth and a really tight labor market. So what we're going to be looking at, meeting by meeting, data reading by data reading, is what's happening with financial conditions and what's happening with the economy. Really, with what effects are changes in policy having on the economy? Are we starting to see what we need to see, which is a really clear and convincing evidence that inflation, if that involves moving past broadly understood levels of neutral, we won't hesitate at all to do that. We won't. And honestly, we will go until we feel like we're at a place where we can say, yes, financial conditions are in an appropriate place. We see inflation coming down. We'll go to that point, and there won't be any hesitation about that time based on what we know at the time. And so So I would say if you replay last summer, we had a real spike in inflation that began in March, April, May, June of last year. And then inflation came down month after month after month for about 4 months, anyway, through the end of the summer. So we were concerned because we saw inflation spreading more broadly, and because we didn't see supply chain issues improving. We didn't see labor force participation improving. So we had real concerns. But still, the incoming inflation data were kind of consistent with our story. And then the data really changed. Changed pretty thoroughly beginning in October, and we responded very much to that. So since then, we pivoted in our policy, and since then, you've seen really quite significant tightening in financial conditions. I don't know that financial conditions have tightened more quickly than this in a very long time. And but that's what happened. And I've said for the last 2.5 months, I've been saying that if you look back in hindsight, give yourself 20/20 hindsight, then yes, it probably would have been better to have raised rates earlier. We were looking at some weak employment reports. We were looking at inflation reports that were coming down. When that stopped, and when the data started pointing toward a stronger economy with higher inflationary pressures, higher wage pressures, we didn't hesitate. From that point, we've really moved. I would say almost expeditiously. Since then we have moved, and you see where we are 6 months later since that happened. You now have the 10 years up, 140 basis points. The 2 years up almost 200 basis points, and the 2-year Treasury is a pretty good measure of policy expectations. So quite a lot of tightening, and appropriately so. Inflation is way too high, and we need to bring it down, and we're going to use our tools to do that. The world who are looking to have a continued expansion in the economy, but also for us from the standpoint of policy. So, the war in Ukraine is pushing up commodity prices for both food and energy. And we don't really know how long that's going to last now. It might have thought at the beginning, and we don't make those kind of judgments that it wouldn't be long lasting. Now it looks like it may be, so that may be a persistent effect. Same thing with the rolling shutdowns in China. They won't last forever, but they'll last for some time, and they're having an effect too. And what they're doing is they're preventing any healing of supply chain problems. So that's going to make it harder for inflation to come down. And so really they've added to the degree of difficulty to what was already a challenging project. Tightening cycles, and in none of those cycles do they look anything like the current cycle. We've never, I won't say never, but I'm not aware of a time when we've had 2 job openings for every unemployed person. And it's just an extraordinary. It's a once in a century pandemic, followed by historically large fiscal and monetary policy support, followed by a war in the middle of Europe between 2 commodity makers, followed by partial shutdown of China, a very large economy. That's the manufacturing center, one of the manufacturing centers of the world. So, can you look in the history book and find that? No, you can't. And so I just think we're in a world of firsts. So I wouldn't say just because it's never happened before, it's impossible. I wouldn't say that. I would say that there are plausible paths, and that this will be challenging, but we'll do our best to achieve it. And in any case, we will achieve price stability. The other thing that's clear, though, is that the effective natural rate can change pretty significantly over the course of an expansion, particularly a long expansion like the last one, where you finally had 3.5% unemployment and no sign of either wage or price inflation. But you had a couple of years there where unemployment was well below 4%. And you didn't see inflation. So that suggests that as that longest expansion in recorded U.S. history, 10 years and 8 months, as that went on, what you saw was matching getting better and better and better and more efficient, and the natural rate coming down. So right now, it feels like the actual unemployment rate is not the perfect. You have to think about where the natural rate is compared to today's employment rate. And it does appear to me that it's probably well above 3.6%. But it should shift down as this highly unusual time in our economy and in our labor market goes on. We should see that settling down, and we should see the natural rate declining, and that itself could reduce wage pressures and inflation pressures.
Well, all things.
We're going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
This effort. And China has big plans for this. They intend to seed their digital yuan into the global environment by giving it away to visitors at next winter's Olympics. When they arrive at the airport, they're going to get yuan digital wallets. They're going to receive digital yuan. They're going to use it throughout their visits to Beijing, and then they're going to take it back to their home countries. They see this as a huge advantage. Why? Because who controls the underlying protocols, who controls the underlying standards of the future of money will control the future of money.
Most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids' books. I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate, not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Grandma Tam save the village. Part 2. King Joshua and Grandma Tam save New York from COVID-33. Part 3. King Joshua and Grandma Tam goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.